Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 1. This is Section A2, and this is an application topic. Apply the ethical requirements and independence rules of the Securities and Exchange Commission and the Public Company Accounting Oversight Board to situations that could compromise compliance or impair independence during an audit of an issuer. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. We will go over the key ingredients to passing the CPA exam, and again, it's only 1 hour, it is free, and we will show you how to pass the CPA exam without wasting months of your time. Seriously, it will save you so much time, just that 1 hour of that training. And after you watch that, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 10 questions. Normally I go over 5, but this is kind of a big topic and I'll talk about that in a second. We're going to be going over 10 questions, but the SuperfastCPA Pro members will get access to the full 20 question video that I'm going to post in the members forum, and I'm going to record it after this. So if you like this and you want to get more, just remember that SuperfastCPA Pro members get the full versions of these videos. Typically they're 5 questions. Today's video is 10 questions. And so they get access to the 10 question videos, in this case, the 20 question video, so they can get more help and more understanding. So again, remember to check out the webinar and remember to check out becoming a pro member. And with all that, let's dive straight into the questions. All right, here we are at question 1. Let's just dive straight in. Something that I like to point out, and it won't be super helpful throughout this video because all of the questions are pretty short, but remember to read the last part of the question first. I usually bold it if there's a big paragraph of information, because that way you know what you're supposed to be looking for. You want to read the last part of the question first to give yourself context for what you're about to be dealing with. And this is a really good test day strategy. So again, this is something you want to get used to. We're not going to be doing it too much in this video because most of the questions are 1 sentence long or maybe 2 sentences long. But remember, this is a good habit to be in. So let's go ahead and do this. Which of the following accurately describes the PCAOB and SEC partner rotation requirements applicable to this audit? And so what is this audit? An audit partner is working on the audit of a publicly traded company, which is an issuer. So basically that's what you need to know. We might talk about issuers more in other videos, but just remember, basically an issuer is a publicly traded company. So let's read through these options and then we're going to look at the explanation to learn what the correct answer is. So A, the lead audit partner and the concurring partner must both rotate off the engagement every 5 years, while other partners involved in the audit must rotate every 7 years. B, the lead audit partner must rotate every 5 years, while other audit partners on the engagement, including the concurring partner, must rotate every 7 years. C, the lead audit partner can serve indefinitely while other partners are subject to a 7-year rotation rule. And D, rotation rules apply only to lead audit partners who must rotate every 5 years while no other requirements exist for other partners on the engagement. So out of all these options, again, which one accurately describes the PCAOB and SEC partner rotation requirements applicable to a publicly traded or an issuer audit? Now in this video, the concepts aren't super difficult. There's just a lot of concepts that you need to know when it comes to the rules for an issuer. So if you have any idea how this works, then, and if you know the rule, that's great. Then you already know the answer. If not, let's go ahead and look at the answer to learn what this rule is. All right, here we are. The answer is B. The lead audit partner must rotate every 5 years, while other audit partners on the engagement, including the concurring partner, must rotate every 7 years. So that's the rule. Now let's go ahead and read through this explanation. The SEC and the PCAOB partner rotation rules for audits of issuers specified the following. The lead audit partner, so the one who's running the engagement, must rotate off the engagement after 5 consecutive years of service. The concurring partner and other significant engagement partners must rotate after 7 consecutive years of service. After rotating off the engagement, both the lead and concurring partners are subject to a cooling off period of 5 years before they can return to their original role on the engagement. These requirements do not apply to non-issuer audits, so for private companies, not publicly traded companies, where partner rotation is not mandatory under SEC or PCAOB rules. So that's one of the rules that we need to go over in this video. Now let's go to the next question. All right, here we are at question 2. Under PCAOB rules, how often is the firm subject to mandatory PCAOB inspections? Okay, let's go up to the top. A registered public accounting firm audits fewer than 100 public companies or issuers annually. So under the PCAOB rules, how often is the firm subject to mandatory PCAOB inspections? So if you know the answer to this, that's great. If not, let's go ahead and look at the answer together to learn this rule. All right, here we are at the answer. The answer is C, every 3 years. So let's read through the explanation. And something I want to point out, probably throughout this video, you'll notice that I'm pretty much just going to be reading the explanations because I created these questions to be very straightforward and very specifically tell you the actual rules. So I don't really need to expound too much on what's here because again, these are the rules and we just need to use each question to learn a different rule. So I'm just going to read through the explanation, and if you need to, pause the video and write these things down if you need to remember them. But anyway, again, I'm going to dive straight into the explanation. The PCAOB inspection frequency depends on the number of audit reports issued annually by a firm. Firms that issue more than 100 audit reports annually are subject to PCAOB inspections every year. Firms that issue 100 or fewer audit reports annually are subject to inspections every 3 years. These inspections assess the firm's compliance with PCAOB standards and help ensure audit quality for public companies. There is no requirement for inspections to occur only in the first year of a firm's public company audits. So that's another rule. If a firm issues more than 100 audit reports in a year, then they need to be inspected by the PCAOB every year. But if they do 100 or less, then they need to be inspected every 3 years. Now let's go to the next question. All right, here we are at question 3. Under the ethical and independence rules for auditors of issuers, which of the following activities is prohibited because it would impair the auditor's independence? So let's read through these. A. Serving as an expert witness to advocate on behalf of a client during litigation or regulatory investigation. B. Providing factual testimony in a legal proceeding about the auditor's work. C. Performing an integrated audit that includes both financial statements and internal controls. Or D. Issuing a comfort letter with pre-approval from the audit committee. Okay, so if you know the answer to this, that's great. If not, maybe pause the video and think through this, or we're just going to look at the answer right now to learn this rule. All right, here we are. The answer is A. Serving as an expert witness to advocate on behalf of a client during litigation or regulatory investigation. That is what is going to impair independence. So let's walk through this. Auditors of issuers are prohibited from providing legal services, including serving as an expert witness to advocate for a client in litigation or regulatory matters. This activity compromises the auditor's objectivity and impairs independence. The following activities, however, are permitted under the SEC and PCAOB independence rules. Providing factual testimony in a legal proceeding regarding the auditor's work, as long as it does not involve advocacy. So if they're just saying, this is what my work was, these are the facts, that's okay. Performing integrated audits, which involve auditing both financial statements to ensure accuracy and internal controls to assess their effectiveness in preventing and detecting errors of fraud, that is something that is allowed, and actually integrated audits are required for issuers under SOX or the Sarbanes-Oxley Act. So it is required to do an integrated audit for issuers, so of course that's something that's not going to impair independence. And then there's issuing comfort letters, which provide limited assurances about financial information to underwriters during securities offerings. Comfort letters must be pre-approved by the audit committee and are typically used to assist underwriters in their due diligence process. And we will talk more about the audit committee in a few questions. But again, this is another rule. Auditors of issuers cannot provide legal services to their clients. That's one of the rules. So with that, let's go to the next question. All right, here we are at question 4. Under the Sarbanes-Oxley Act, or SOX, how long does a member of an external audit team wait before accepting a senior financial position, such as CEO, CFO, CAO, or controller, with an audit client that is an issuer? So how long do they have to wait? If you know the answer to this, then that's great. You already know the answer. If not, let's go ahead and look at the answer to learn what this rule is. Again, this whole video is just a whole bunch of small rules when it comes to the SEC and PCAOB rules for independence for issuers. So let's go ahead and look at the answer. All right, here we are. The answer is D, 1 year. So Sarbanes-Oxley Act, or SOX, mandates a 1-year cooling off period before a member of an external audit team can accept certain senior financial roles, such as a CEO, CFO, CAO, or controller, with an issuer. This rule ensures the auditor's independence is not compromised by potential conflicts of interest resulting from employment with the audit client. The 1-year rule applies specifically to senior financial positions that could significantly influence financial reporting. Other roles, such as staff accountant or non-senior positions, are not subject to this restriction. So specifically, senior financial roles, CEO, CFO, they are restricted and they have to have this cool off of 1 year. But if you're just a normal staff accountant, you don't have to. Now let's go to the next question. All right, here we are at question 5. Which of the following statements aligns with these provisions? So let's go up to the top. Under the Sarbanes-Oxley Act, Titles 3 and 4 impose several requirements on issuers regarding financial reporting, certifications, and ethics. So again, which of the following statements aligns with these provisions in Title 3 and Title 4? Let's look at A. Only the CEO is required to certify the accuracy of annual and quarterly financial reports. And then let's look at B. CEOs and CFOs must certify that internal controls were evaluated within 180 days of the report date. Then let's look at C. Issuers must disclose whether they have adopted a code of ethics for senior officers and explain any reasons for not having one. And then there's D. Companies are not required to disclose their rationale for the absence of a code of ethics. So with all that, which one of these is the correct one? Let's go ahead and look at the answer to learn the correct rule here. All right, here we are at the answer. The answer is C. Issuers must disclose whether they have adopted a code of ethics for senior officers and explain any reasons for not having one. So that is something that is required. So let's talk about each of these. SOX Title 3, which is about corporate responsibility, focuses on enhancing accountability for financial reporting by requiring that both the CEO and CFO certified the accuracy of annual and quarterly financial reports, and that the certification that internal controls were evaluated is within 90 days prior to the report date, not 180 days. So answer B was incorrect. SOX Title IV, which is about enhanced financial disclosures, emphasizes transparency in financial reporting and ethics by requiring that issuers disclose whether they have adopted a code of ethics for senior financial officers, so that'd be the CEO, CFO, and the controller. And if no code of ethics has been adopted, issuers must provide an explanation for this absence. All right, so a good few rules there. SOX Title III is about the CEO and CFO having to give annual and quarterly financial reports, and the SOX Title IV is about having a code of ethics for senior officers. Now let's go to the next question. All right, here we are at question 6. Which of the following responsibilities is specifically assigned to the audit committee under SOX? So let's look at the options. Option A, certifying the accuracy of annual and quarterly financial reports. B, preparing a report on the effectiveness of the company's internal controls over financial reporting. C, pre-approving all audit and permitted non-audit services provided by the external auditor. Or D, delegating oversight of the external auditor to the CFO or other members of management. So which of these is a responsibility that is specifically assigned to the audit committee under the Sarbanes-Oxley Act? With all that, let's go ahead and look at the answer to see what the correct answer is. All right, here we are. The answer is C, pre-approving all audit and permitted non-audit services provided by the external auditor. So that's something that the audit committee does do. So let's walk through this. SOX establishes specific responsibilities for the audit committee to enhance auditor independence and ensure proper oversight. These include pre-approving all audit and permitted non-audit services performed by the external auditor, appointing, compensating, and overseeing the external auditor, including reviewing their performance and independence, and ensuring that the external auditor reports directly to the audit committee, not to management. And then let's talk about a couple other things. The external auditor, not the audit committee, prepares the report on the effectiveness of the company's internal controls over financial reporting as part of the integrated audit process, and the audit committee is independent of management and cannot delegate oversight of the auditor to the CFO or any other member of management, as this would impair its independence. So the audit committee is basically just a committee that oversees the external auditor and makes sure that they are compensated, make sure that they're doing the things that they're supposed to, make sure that the external auditor is reporting to them. That's what the audit committee does. Now let's go to the next question. All right, here we are at question 7. What is the primary requirement and related disclosure obligation concerning a financial expert on the audit committee? Under the Sarbanes-Oxley Act, issuers are required to evaluate the qualifications of their audit committee members. And again, what is the primary requirement that you have to have for a financial expert? Let's look at the different options. A, the audit committee must include at least one financial expert, and the issuer must report their qualifications to the SEC. B, the issuer must disclose annually whether the audit committee has a financial expert, and if not, explain the reasons for their absence. C, financial experts are required only for companies listed on stock exchanges, not for all issuers. And then there's D, the board of directors must appoint a financial expert within 30 days of identifying a vacancy. So again, which one of these is the correct one? As you'll see throughout this whole video, really what we're doing is just using these questions to learn the correct answers so that you can then, from now on, remember the correct answers, so that if you see this on the review course of your choice or on the exam, then hopefully you'll remember these rules. So that's why we're going through these. Let's go ahead and look at the answer for this one. All right, here we are. The answer is B, the issuer must disclose annually whether the audit committee has a financial expert, and if not, explain the reasons for their absence. So that is something that is required for a financial expert when it comes to the audit committee. Let's go ahead and talk about this. Under SOX, issuers are required to evaluate whether their audit committee includes a financial expert. The role of a financial expert is critical in ensuring proper oversight of financial reporting and audit processes. A financial expert is defined as an individual with significant knowledge and experience in financial accounting, auditing, and reporting, such as a CPA, auditor, or someone with similar qualifications. SOX does not mandate that every audit committee must have a financial expert, but the issuer must disclose in its annual report whether it has a financial expert on its audit committee, and if the issuer does not have a financial expert, it must provide an explanation as to why. This disclosure enhances transparency and informs investors about the audit committee's ability to oversee complex financial reporting matters. There is no penalty or specific timeline for appointing a financial expert, but the absence must be justified publicly. All right, now let's go to the next question. All right, here we are at question 8. Willfully destroying documents to obstruct an investigation, as prohibited under Title 8 of SOX, can result in which of the following penalties? So could it result in a fine, imprisonment for up to 20 years, both a fine and imprisonment for up to 20 years, or a permanent suspension from practicing before the SEC? Let's go ahead and look at the answer to see what the rule is here. All right, here we are. The answer is C, both a fine and imprisonment for up to 20 years. So that's what can happen if you are destroying documents to obstruct an investigation of your audit. Title 8 of SOX, also known as the Corporate and Criminal Fraud Accountability Act, enforces severe penalties for knowingly destroying or falsifying documents with the intent to obstruct a federal investigation or legal proceeding. Penalties include, again, fines and imprisonment for up to 20 years, or both fines and imprisonment depending on the court's ruling. Permanent suspension from practicing before the SEC is not a penalty directly tied to this offense, but may apply in cases involving professional misconduct. Title 8 ensures that such actions are treated as serious criminal offenses to protect the integrity of investigations and corporate accountability. All right, so you can go to prison for up to 20 years and be fined if you are knowingly destroying or falsifying documents when there's an investigation going on. Let's go to the next question. All right, here we are at question 9. Under SOX and PCAOB independence rules, which of the following scenarios would impair an auditor's independence when providing non-audit services to an issuer audit client? So would it be A, providing tax compliance services that have been pre-approved by the audit committee? Is it B, offering financial information systems design and implementation services exceeding 5% of total fees paid by the client without pre-approval? Is it C, issuing a comfort letter in connection with underwriter due diligence for the client? Or is it D, performing routine bookkeeping services for a private non-issuer client? So again, with all those, let's go ahead and look at the answer to see which one of these is going to see which one of these would impair an auditor's independence when they're doing non-audit services for an issuer client. All right, here we are at the answer B, offering financial information systems design and implementation services exceeding 5% of total fees paid by the client without pre-approval. So let's talk about all this. SOX and PCAOB independence rules impose strict limitations on the non-audit services auditors can provide to an issuer to avoid conflicts of interest. So option A, tax compliance services are allowable if they are pre-approved by the audit committee and do not involve aggressive tax strategies or advocacy roles that could impair independence. Option B, financial information systems design and implementation service for issuers are strictly prohibited unless pre-approved by the audit committee. Even with pre-approval, such services cannot exceed 5% of the total fees paid by the issuer to the auditor, or independence is impaired. And then there's option C, comfort letters issued in connection with underwriter due diligence are permitted, provided they are related to the audit and are pre-approved by the audit committee. And then option D, routine bookkeeping services are prohibited for issuer audit clients as they impair independence. However, the option specifies a private non-issuer client, where such services are permissible under less stringent rules. So you could have gotten caught up by option D if you kind of knew that rule, but maybe didn't remember that they were a non-issuer. So remember, all of these do not cause impairment of independence when it comes to auditing an issuer, except for option B. All right, let's go to the next question. All right, here we are at question 10. Which statement is correct regarding auditors of issuers under SOX and PCAOB rules? There's A, they must perform an integrated audit that covers both the financial statements and management's assessment of internal control. There's B, they are not required to register with the PCAOB as long as they are licensed CPAs. There's C, they can provide tax services to senior financial officers like the CFO without special disclosures. And then there's D, they must issue a separate opinion on internal controls only if requested by management. So which one of these is true, which is correct regarding auditors of issuers under SOX and PCAOB rules? Now, we haven't talked about this necessarily, but based on all the things we've learned so far, maybe you have an idea. Maybe pause the video if you want to. If not, let's go ahead and look at the answer together. All right, here we are. The answer is A, they must perform an integrated audit that covers both the financial statements and management's assessment of internal control. So that is something that is required. So let's go ahead and walk through this. Auditors of issuers are required under SOX and PCAOB rules to perform an integrated audit, which includes issuing opinions on the fairness of the financial statements in accordance with applicable standards and the effectiveness of management's assessment of internal control over financial reporting. Now, the other options are incorrect for the following reasons, so let's talk about them. Option B, audit firms must register with the PCAOB to issue audit reports for SEC registrants, regardless of CPA licensing status. Registration ensures that the PCAOB can inspect and oversee the firm's compliance with auditing standards and independence rules. Option C is wrong because tax services provided to senior financial officers, such as the CFO, are either prohibited or subject to stringent restrictions and disclosure requirements to maintain auditor independence and avoid conflicts of interest. And then finally, option D, issuing a separate opinion on internal controls is mandatory for issuers under SOX, not optional or subject to management's request. All right, with that, we've learned a lot in 10 questions. I know typically we do 5 questions, so this probably felt like a lot. Before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You'll see these things multiple times throughout the questions, so you take the time to write them out as the most important things that you learned from the questions. Sometimes it's hard with audit because there can be so many questions and so many little different rule applications, but taking the time to kind of condense it and summarize it and figure out what is key and what is most important will be worth your time. So with that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics for this video. Now, this is way more than we typically see because normally we're only doing 5 questions. We did 10 questions this time, so each one kind of had something to do with the pillar topic. So let's walk through this. Partner rotation. For issuer audits, the lead audit partner must rotate off every 5 years, while other partners rotate off every 7 years. For PCAOB inspections, firms issuing 100 or fewer audit reports annually are inspected by the PCAOB every 3 years. And remember, if they issue more than 100, it's every year. Now let's talk about prohibited services. Auditors of issuers cannot provide legal services or expert opinions advocating a client's position in litigation. There is a cooling off period. Let's talk about that. A member of the audit team cannot become CEO, CFO, CAO, or controller of an issuer client for 1 year following the engagement. Then there's audit committee duties. The audit committee pre-approves all audit and certain non-audit services, appoints and compensates the auditor, and oversees the audit work. Now let's talk about the financial expert requirement. Issuers must disclose whether their audit committee has a financial expert or explain why not. Then there's the CEO and CFO certification, and that's Title III. Both the CEO and CFO must sign annual and quarterly reports asserting the effectiveness of internal controls within 90 days prior to the report. Let's talk about the Code of Ethics. This is in Title IV. Issuers must disclose if they have a Code of Ethics for senior officers or why they do not. Then there's document destruction. That was in Title VIII, and again, this is all in the SOX or Sarbanes-Oxley Act. Knowingly destroying documents to impede an investigation can result in fines up to 20 years in prison or both. And then finally, for integrated audits, remember that auditors of issuers are required to perform integrated audits of both the financial statements and management's assessment of internal controls. So again, those were kind of some of the pillar topics, but some of the most important things you needed to learn from those previous 10 questions. And with that, we've done the YouTube part of this video. Remember, SuperfastCPA Pro members will get access to the full video where I'm about to do another 10 questions with them, and they're going to get a little bit more understanding and a little bit more help with this topic. So if you like this and you like our other videos, remember, go check out the SuperfastCPA training webinar. It's only 1 hour, and we will teach you how to pass the CPA exams in just 1 hour. And after that, you're going to want to learn more, so make sure you check out becoming a Pro member, because remember, Pro members get access to the full versions of these YouTube videos where they get more practice and more understanding. So with all that, I hope this was helpful. If you liked the video, make sure to like it and leave a comment. And with all that, I will see you in the next video.